Hey everybody, so I just opened up a WeBull account to complement my Robinhood account, compare the platforms a little bit, see how they work, and so I decided I need a strategy for investing in the WeBull account, and so in particular I decided this time around I'm going to look at the Dividend Aristocrats. So this is a group of 57 different stocks, members of the S&P 500, that have increased their dividend every year for at least the past 25 years. And so this here is a list of the Dividend Aristocrats. You can see there's a handful of companies here, some well-known companies, some companies that aren't necessarily name brand household companies. So I'm going to be investing in these companies, and because we can't do fractional shares, we'll have to decide what kind of shares to purchase first, and we'll also need to decide a weighting. So first, let's talk about the weighting. Now, a lot of index funds are weighted by market cap. So if a company is worth twice as much in the stock market as another company, the sum total of all its shares, that would be weighted twice as heavily. That's what you typically get when you buy an S&P 500 index fund. So if Microsoft is twice the size of Coca-Cola, you'd have twice as much value invested in Microsoft as you would in Coca-Cola. Instead here, I'm going to be weighting these by total dividend payout. So not by dividend yield, but rather by total dividends paid to all shareholders combined over the past year. So looking at this list here, you can see ExxonMobil has paid out $14 billion in dividends to shareholders over the past year. Johnson comes in second with $10.2 billion, AT&T in third with $10.1 billion. And so the weighting is based on how much they've paid out in dividends. So, for example, here we can see VF Corporation has paid out $2.8 billion in dividends, whereas AbbVie has paid out $5.2 billion, and so that's about twice as much. And you can see that's weighting, its desired weighting in the portfolio is also twice as much. So my target is to have this portfolio be 11.72% ExxonMobil, 8.5% Johnson & Johnson, and then you can see here lower amounts. For example, Emerson Electric has paid out $1.2 billion in dividends over the past year, so that gives them a 1% rating in the portfolio because they paid out about 1/10 as many dividends as ExxonMobil, so has about 1/10 the weighting. Starting out today, everything has weight 0, so everything is underweight in my portfolio. So I'm going to I have to start by buying one of these stocks on the list, and so the way I'm going to decide which stock to buy next is I will look at every stock that is underweight the most. I'll take the 10 most underweight stocks. Right now, every single stock is tied for the most underweight because I've bought none so far. But I'm going to look at the most underweight stocks, and of the 10 most underweight stocks, I'm going to look at the stock that is closest to its 52-week trading low. So right now, when we go down the list, I have that stock highlighted here. That's W.W. Grainger. So W.W. Grainger is currently trading about 5% above its 52-week low, whereas some other stocks here, like for example, ExxonMobil is 20% above its 52-week low. Procter & Gamble is 48% above its 52-week low. Yeah, but W.W. Grainger is the closest to its 52-week low. Since I'm going to be buying all these shares regardless, I'm going to start with the ones that are close to lows and then build up from there. Let's take a look at W.W. Grainger. So this is an industrial supplies company. They do motors, fasteners, plumbing, tools, etc. So it's not really a household name. It's more what industrial buyers would be buying from. And so, looking at W.W. Grainger there, each share sells for currently about $2.69, close to that. These prices are not real time, but I cashed them about an hour or so ago. The 52-week low was $2.55. And so over the past year, this company has paid out $5.52 to each of their shareholders. And that's a yield of about 2%. So not a huge yield, but it's sort of on par for what these companies pay here. These companies are often have relatively small yields because shareholders are counting on those further dividend increases, and so that bids down the yield price because shareholders are willing to pay a bit more for it. But historically, the S&P 500 Aristocrats, these stocks here that have increased their dividends, they've outperformed the S&P 500 historically, and there's been lower volatility as well. So it's not just that you're getting better performance in exchange for higher volatility, but instead you both have lower volatility and better performance. So this is probably a solid group of stocks to invest in, and I'm going to be investing them weighted by total dividend payout over the past year. So every time one of these companies increases their dividend yet again, it'll bump up its weight in the portfolio. And if any of them ever decrease their dividend, then they will be kicked off the aristocrat list, and I will stop buying new shares. I won't sell my existing shares, but I'll stop buying new shares inside my WeBull account. Right now, the account is funded with $1,000. I plan on adding $250 a week and buying whatever comes next on the list. So this is my first trade in WeBull, so we'll see if I make any mistakes. I have it open here in Chrome on my desktop. They also have an Android app and an iPhone app, but I prefer to do my investing on a real computer. And so my first buy is going to be symbol GWW. That's WW Granger. And let's go see here. I've already got it pulled up here, and so I'm going to go ahead and so the current price is $269.54. So it's gone up a little bit today so far. So if I made this video a little earlier, I would have saved $1. But let's go here and let's go ahead and place an order. So it wants my PIN. Let's go see if I can remember it. And there we go. That was the correct PIN. We're going to do a buy. Okay, limit order, and that's the current price right there. And let's see, quantity. I want to buy one. Just buy one share. There we go. Place order, and we're going to go ahead and hit buy. And it's going to submit that order, and we'll see if it gets filled or not. It wants to show notifications. I don't need you showing notifications. I can log into the site if I want notifications. All right. And then now that we have that buy order pending on here in my little tracking app, I'm going to go ahead and hit this plus button, and that will indicate to the app that I've now bought one share of that. And now you can see this is massively overweighted in my portfolio. This should just be 0.25% of my portfolio, and now it's 100% of my portfolio. So it's overweighted by thousands of percents. And so now we're going to go through this list here and see who is next to buy. Next on the list is AbbVie. So AbbVie is a pharmaceutical company. They're a spinoff of Abbott Labs. And they're also trading relatively close to their 52-week low. And one reason for that is they recently announced a takeover of Allergan, and for whatever reason, there's lots of reasons that has weighed on their stock price. Perhaps one of them is that they're going to be, I think Allergan might be a little bit debt-laden, so they're going to be taking on some debt. And that may mean that they have to use their cash to service debt, and and that may imperil the future dividend prospects. But AbbVie has been, or in their previous incarnation as Abbott Labs, they have been increasing their dividend consistently for 25 years. So that's not something that they would take lightly, because they've been working on that investor trust. So I'm going to go ahead, pop back over to WeBull, symbol ABBV. All right, let's go here, load up ABBV. And we got AbbVie on our screen there. And we're going to go put in a buy order for one share. And we'll go ahead and place that order. Ask us to confirm. We confirm. Submitted successfully. And we can see that we now have a position with WW Granger, and it's working on doing that AbbVie order there. And I'm going to go ahead and pop back over here and mark this as purchased. Head back on the list. Oh, and the next one on the list is 3M. So you probably know 3M. They're a materials company. You probably bought, tape made by 3M. And they do all sorts of materials. Probably a lot of industrial things in there too. And they're also trading just 8% above their 52-week low. Their dividend yield is 3.25%. You can see right up here with AbbVie, I didn't mention that. Their dividend yield has been bid all the way up to 4.45%. So their stock is trading at a relative low because presumably investors are not so confident that these dividend increases will continue. Whereas 3M, midline dividend yield 3.25%. Their stock pays out about $5.60 in dividends per year, at least over the past calendar year. It has historically increased every year. And so let's go pop over here and look at 3M. There we go. 3M has the symbol of 3 M's in a row. Makes sense for them. And we will go place an order to go buy one of these. Place order. And submit that. And now it is busy. It's busy working on that. Alrighty. Now, head back over here. We'll indicate that we bought 3M. Alright. head on down the list here, see what's up to buy next. Okay, the next one is the very last one on the list. So this is the company that's paid the least amount in dividends, total dollar value of dividends to its shareholders over the past year. So they've paid out $153 million to shareholders over the past year. So this is the one that's going to be weighted least in the portfolio in the long term. But they're also trading relatively close to their 52-week low. So that's why we're going to go ahead and buy it now. This is a relatively inexpensive stock here. Each share is only $37.84. So yeah, let's go ahead and oh yeah. So this is Pentair. They're a water treatment company, and yeah. And so let's go over here, symbol PNR, purchase a share of that, PNR. Okie doke. And we got all of our options up there. Place order and submit. And we can see so far all of our orders have been successfully filled. And there we go. We'll mark that up as one. And so now this comprises 6.89% of our portfolio. So it's overweight by 5,000% because this should be the least weighted stock in our portfolio over the long term. But I'm buying it now because it's close to its 52-week low. Yeah, I'm going to buy one of every share before I start buying seconds of any other shares. And so let's go through our list here. And now we're up near the top of the list. So we're looking at Johnson & Johnson here. Yeah, you know, it says the pharmaceutical giant. You probably use their baby shampoo, or your mom did when you were a baby. At least my mom did. And you probably put Band-Aids on your hand, which is their name brand. Yeah, and so big pharmaceutical company. Yeah, this is number 2 on the list overall of total dividends returned to shareholders. So they've paid out about $10 billion over the past year as returns to shareholders, and yeah, each individual share is 3.65 cents, and so we're trading relatively close to the 52-week low, 10% above. Yeah, so we'll hop over here, get a symbol of Johnson & Johnson. There we go. There's Johnson & Johnson. And we're going to go ahead and put in that buy order, place order, buy. And let's work on filling that. So let's go ahead and knock that up by 1 right there. All right. So far we should have spent around $680 buying these stocks, at least based on an hour ago's quotes. Yeah, let's see. Does WeBull make it obvious how much buying power I have? Yep, right here is my buying power. So of the $1,000 that I put in, into my account, I still have $317 left to go buy shares. So let's go see if the next stock is under $317. And yeah, the next stock on the list is Archer Daniels Midland Company. I only know this from commercials that they had on PBS decades ago when I was a kid, and it had a picture of a combine or something harvesting wheat, and it said ADM, supermarket to the world. So this is a food processing company. Yeah, they make oils, flours, sweeteners. So they take they take commodity agriculture products and process them further, and I think they also do some commodities investing. And so, yeah, that's ADM. They've paid out about $750 million to shareholders over the past year, and so each share is going to give us $1.37 in dividends, at least looking back over the past year. And so yeah, let's go buy a share of ADM. So we got ADM right here, Archer Daniels Midland Company, and we will go place an order here, put in our buy, and we'll knock it up by 1 over here. And so now this is overweighted in our portfolio. This should only be less than 1% of our portfolio, but it's currently about 5.7%. And we'll scroll around and see where the next one is. Okay, yeah, next one on the list is A.O. Smith. They do water heaters, of all things. So, yeah, so we got A.O. Smith right here. Also, relatively inexpensive share. Like, yeah, each individual share is not expensive. Obviously, the dollar value of a share is irrelevant to the value of a company. Berkshire Hathaway is notorious for having their primary shares costing over $100,000 a piece. They could do a stock split and make each individual share cheaper, but I guess they like that. You can see, going through the list here, most of these companies are in the $100 to $200 range. It sort of seems to be a popular place for them to like to keep it. They can always do stock splits to make each individual share cheaper. But yeah, I guess companies like to project certain images. So you don't necessarily just do stock splits willy-nilly, but most of these companies have not let their stocks get up above $1,000 per share. So looking here, I think the most expensive one I've seen so far, is Sherwin-Williams right here. We're looking at $467 per each share. All right, but the next one I'm going to be buying here is A.O. Smith. So simple AOS. AOS. There we go. And we're putting in a buy order right here. And we're going to place our order. Buy. And it's going to work on fulfilling that order. I'm going to go back to my tracking tool here. Look up A.O. Smith, buy 1. And then let's go see who's next. Next one is Cardinal Health. I believe they're a healthcare and pharmaceutical distribution company. Another healthcare company on this list. We've already had AbbVie and Johnson & Johnson. Now we got Cardinal Health. That makes sense. The healthcare industry is a large percentage of our GDP. So there are some big companies doing big business there. So Cardinal Health. CAH. And so we're going to go ahead and buy 1 share of this. Place order. Submit our buy. There we go. Our buy is in. All right, and we still have buying power of $230 available, so we'll go ahead and tag Cardinal Health off the list here. And we're overweight on Cardinal Health now because that should only be 0.5% of the portfolio, but it's 5.8% of the portfolio. And let's go see who's next. Next is Walgreens Boots Alliance. So another healthcare industry stock here. Most of you in America probably know Walgreens, the pharmacy chain, and Boots is a UK pharmacy chain. So this company was created by a merger a few years ago. So now it is the Walgreens Boots Alliance, symbol WBA. They're currently trading 13% above their 52-week low. Dividend yield is a solid 3.15%. So it is neither too high, indicating that stockholders are nervous about a future cut dividend, nor is it too low. So they're not being lazy with their dividend payouts, and they paid out $1.5 billion over the past year to shareholders. Let's go over here. WBA. There we go. Submit or buy. Place order. Buy. Okey-doke, well that's being filled. Let's go over here. Mark that as the next one bought on our list. And let's go see who's next. Scrolling through this list here. We've got Federal Realty Investment Trust. So this here is a real estate investment trust, and they own shopping centers in the U.S., I think mostly on the East Coast and in California. I'm actually surprised that the dividend yield is as low as it is. Shopping centers in America aren't as strong as they used to be. Perhaps this particular real estate investment trust has just very strong shopping centers that are expected to weather the Amazon storm. So dividend yield of just 3.11%, which is lower than you would get for a lot of real estate investment trusts. And so the thing is about real estate investment trusts, they're required to pay out a large percentage of their profits out to shareholders each year. And if they do so, and they meet other rules and requirements, the corporation itself does not pay any corporate income tax. But the dividend you receive as an investor will be taxed as ordinary income rather than at your capital gains tax rate. So there are some tax consequences for you as an investor. That dividend will be taxed higher than a lot of the ordinary dividends that you would get from companies that aren't real estate investment trusts. But these companies are basically required to pay out consistent dividends as long as they are making a profit. And Federal Realty Investment Trust, they've been increasing their dividend for 25 years. They've made it onto the S&P 500, which is not common for real estate investment trusts because they tend to be smaller. And so let's go ahead and buy 1 share of that. Currently trading around $130. So let's go over here. FRT. Perhaps a little bit of an unfortunate symbol name. If you add in the vowel, it becomes a little bit less polite. And you can criticize me for thinking that, but you may have been thinking it too. So let's go here, hit place order. Oh, and buying power is insufficient. So we are stuck for the day, unfortunately. We just have $127 of buying power left. This share is $131.46. So I'm going to pause for today. I'm going to transfer over another $250 for next week. It may be that FRT is the next one on our list to buy next week, or it may possibly be that another company will be trading closer to its 52-week low, and we'll buy a different one first. Yeah, I hope to add $250 every single week, and then buy until I have insufficient buying power to go buy the next one. Yep. Since this was my first time using WeBull, just sort of a quick reaction is the interface is a little bit more robust than Robinhood's interface. It's got a lot more stuff on the screen here. For example, the default action in Robinhood is just a straight market buy. Here, actually, their default is a limit order rather than a market buy. With the market buy, you sometimes end up paying a bit more than the current quote. It basically says, hey, go fill this order with whatever you can do best, and it'll fill it as fast as it can. Limit says don't pay more than this amount, and so it may not be filled at all if the stock is currently going up at that very moment. It may just not be filled. So you have a time and force here. It'll put out that order for the entire day, for example. If I wanted to, I could put a limit order for 127.55. It's possible the stock would drop to that amount over the course of the day. These tend to be slightly more stable stocks, so that would actually be a fairly significant percentage right there. That would be about a 3% drop. And this stock is down 0.19% for the day. So unless it was just a tumultuous day in the stock market and everything was dropping, it probably would not get filled. So you can see there's right here, just looking at it, there are more options that you can do just right on the front screen. With Robinhood, you have to hit the advanced button to go get some of these things here. And they have fancier looking charts. You'd have to know how to read these charts to make any use of them. I switched this over to year. I think their default when I came in here was just looking at the maybe 15-minute chart. That was what I was looking at. I'm not the sort of person who would trade stocks by the minute. So this is going to be a buy and hold forever account. My goal is to never sell any of these shares ever. And then eventually these stocks have a reputation of increasing their dividends. Some of these companies, of course, will decrease their dividends. Some of them will probably go out of business. But hopefully over the long haul, these companies will increase their dividends, and then the cash flow from this will be sufficient to pay for whatever I'm hoping to achieve from this portfolio. So essentially financial independence. So live off the cash flow. So rather than liquidating shares, live off the cash flow that these companies make. 10 years down the road, hopefully all these dividends should be much higher. So right now, the portfolio that I'm looking at, computed here, I bought a total of 9 shares. The estimated annual dividend payout among all these 9 shares is $24.64. Portfolio value is currently about $8.72. So the yield on what I spent today is about 2.82%. But if all these companies, looking a decade or so down the line, if all these companies have doubled their dividends by that point, that may be a little bit ambitious, but if they've doubled their dividends by that point, then looking at that, I'm going to be making 6% yield on the money that I invested. So not 6% yield on the value of the shares at that point, because presumably the share value will go up. Perhaps there'll be a bad 10 years coming up and the share value will go down. But if all these companies stick with their dividend increase strategy, then this dividend amount should be significantly higher 10 years from now. And even if 1 or 2 companies cut their dividends, presumably of these 57 companies that have been at it all for 25 years at this point, the majority of them should want to maintain that status. These are companies that have a history of caring about the cash flow of their shareholders. And if you read the Wikipedia article about the dividend aristocrats, there are some companies that drop off the list, and those typically companies that had some bad years during a downturn, and they just didn't have enough cash to keep paying out their dividends. They weren't making the profits that they used to, and they couldn't increase their dividends, so they had to do a dividend cut. All these companies here are ones that weathered the last financial crisis just a handful of years ago, and have weathered previous financial crises over the past 25 years and have consistently increased their dividends. And so that demonstrates a pattern within management that they wouldn't just change willy-nilly. So, hope you enjoyed this video. If you like this stuff, go ahead and hit the bell to hit the subscribe button to subscribe. Hit the bell for notifications. Give the video a thumbs up. I'd appreciate that. Helps the YouTube algorithm figure out what's liked. And good luck with your investing, and I'll keep you guys posted in this account, adding $250 a week and buying more stuff. And well, we'll see how this compares to my other portfolios. Okay, bye.